Hello friends, and a warm welcome to the monthly macro update. Today we are going to be briefly discussing the rise in the Indian G-Sec yields that we have seen recently. The yield curve has seen a steep hardening, specifically at the longer end of the curve. The 10-year yield has risen almost 25 basis points despite a 25 basis point rate cut announced in the repo rate by the Reserve Bank of India. Various reasons have led to this recent sell-off seen in the G-Sec market. The foremost one being the recent RBI's monetary policy. While the policy announced a rate cut, the policy language and tone reflected quite a neutral to hawkish stance. The Reserve Bank of India categorically dropped the mention that the accommodative stance would be continued. The Reserve Bank also stated that it had utilized all the available space for rate easing. This kind of a policy led to reduced hopes of further rate easing in the near term. Moving on from the Reserve Bank of India's monetary policy, we have the projections of the southwest monsoon by the IMD. So the IMD has projected the southwest monsoon for FY16 at 88% of the long period average. The delayed monsoon has already led to a rise in vegetable prices in the month of June. 2 consecutive years of irregular monsoon could have an adverse impact on food inflation. Apart from food inflation, if we move on to the fuel inflation, amidst all the geopolitical tension, the crude prices have risen by roughly around 5%. This has led to a rise in petrol and diesel prices being announced in India. This will also be factored in the inflation figures for India. Apart from the macro variables, if we consider the regulatory aspect, the FII investment limit at around $30 billion for the G-Sec category has been almost completely exhausted. Until this FII investment limit is hiked, there is no scope for any further fresh debt flows into the Indian economy. Apart from this, the 10-year yield for India has also risen in the backdrop of rising global yields. If you have a look at the US and UK and the German 10-year yields, the US as well as the German yields have risen by almost 40 to 50 basis points. So we have the Indian yields rising on the backdrop of all these aspects. That is a reduced scope of further rate easing in the near term, rising crude oil prices, a deficient monsoon that is expected because of the El Nino impact, the FII investment limit which is almost exhausted, as well as rising global yields. While these concerns remain, if we look at it in terms of absolute spreads, so we have the repo rate at 7/4 while the 10-year yield at 7.88. This looks quite an attractive spread. Also, the recent inflation data that was released for CPI at 5% was much lower than the market expectations. And in case the FII investment limit is hiked, that would also provide a lot of buying support. We expect the 10-year yield to trade in the range of around 770 to 790 in the near term. Thank you all for your time and attention.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.